You're finally ready to start investing, but you're absolutely terrified of buying at the wrong time. What if you invest your money today and the market crashes tomorrow? What if you wait for a dip and the market just keeps going up without you? You're paralyzed by this decision, watching your cash sit in your savings account, earning nothing, while you try to figure out the perfect moment to jump in. Meanwhile, your friends who started investing years ago are watching their money grow, and you're stuck at the starting line, afraid to make a move. Here's the truth that's going to change everything for you. There's a dead simple investing strategy that completely removes the need to time the market. It takes all the emotion out of investing and has been proven to work for millions of people over decades. It's called dollar cost averaging. And by the end of this video, you're going to understand exactly how it works and why it might be the perfect strategy for you to finally start building wealth. Let me start by explaining what dollar cost averaging actually is, in the simplest terms possible. Dollar cost averaging, which people often call DCA, is when you invest a fixed amount of money on a regular schedule, regardless of what the market is doing. Instead of trying to figure out the perfect time to invest all your money at once, you just invest the same amount every week, every month, or every paycheck, no matter if the market is up, down, or sideways. That's it. That's the whole strategy. It sounds almost too simple to work, but the math behind why it's effective is actually pretty brilliant. I'm going to show you exactly how it plays out in real situations. Here's how dollar cost averaging works in practice. Let's say you have $1,200 that you want to invest, and you're trying to decide between putting it all in at once or spreading it out. With dollar cost averaging, instead of investing the full $1,200 today, you'd invest $100 a month for 12 months. Each month, when your $100 goes into the market, you're buying shares of whatever investment you chose, maybe an index fund or a stock. The key thing is that the price of those shares changes every month. Some months the price is high and your $100 buys fewer shares. Other months the price is low and your $100 buys more shares. Over time, this averages out your purchase price. And here's the magic. You automatically buy more shares when things are cheap and fewer shares when things are expensive, without having to time the market at all. Let me give you a concrete example with real numbers so you can see how this actually works. Imagine you're investing in an index fund and you commit to investing $200 every month for 6 months. In January, the fund is trading at $50 per share, so your $200 buys you for shares. In February, the market drops and the fund is now $40 per share. Your $200 now buys you 5 shares. In March, it drops even more to $33 per share, and your $200 buys 6 shares. In April, the market starts recovering, and it's back to $40, you get 5 shares. In May, it continues up to $50. You get 4 shares. In June, it's at $60 per share. You only get 3.33 shares. Over these 6 months, you invested $1,200 total, and you accumulated 27.33 shares. Your average price per share was about $44. But notice what happened. If you had invested all $1,200 in January when the price was $50 per share, you would have only gotten 24 shares, and you'd be feeling pretty bad watching the price drop in the following months. But because you spread it out, you bought more shares when prices were low, which brought down your average cost. And if you had tried to time the market and waited until March when the price was lowest at $33, you would have gotten 36 shares if you timed it perfectly, but in reality, most people wouldn't have timed it that perfectly and they might have missed the bottom entirely, waiting for it to drop even more. This is why dollar cost averaging is so powerful. It removes the need to predict the future or time the market perfectly. You're not trying to outsmart anyone or catch the bottom. You're just consistently investing. And the math works in your favor over time. You get to participate in the market's growth without the stress of trying to pick the perfect entry point. Now, I want to address something important. Some people will tell you that mathematically, investing a lump sum all at once typically outperforms dollar cost averaging because the market tends to go up over time more often than it goes down. And from a pure math standpoint, they're not wrong. If you have a large chunk of money sitting around and you invest it all immediately, and the market goes up from there, you'll do better than if you had spread it out. But here's what those people miss. Investing isn't just about math. It's about psychology and behavior. Most people don't actually have a large lump sum sitting around waiting to be invested. What they have is a regular income, a paycheck that comes in every month. And they're trying to figure out how to invest portions of that income over time. Dollar cost averaging is perfect for this real-world situation. You're not choosing between investing $12,000 all at once versus spreading it out. You're choosing between investing $200 this month or not investing at all because you're scared of bad timing. Dollar cost averaging gives you a framework to actually start investing instead of sitting on the sidelines forever, waiting for the perfect moment that never comes. There's also the psychological benefit of dollar cost averaging that's huge, especially for beginners. When you invest everything at once and the market drops right after, it feels terrible. You see your account balance in the red and you panic. You might even sell and lock in your losses. But with dollar cost averaging, when the market drops, you're actually kind of happy because you know your next investment is going to buy more shares at a discount. It flips the psychology from fear to opportunity. Instead of dreading market dips, you welcome them because they mean you're getting a better deal on your regular purchase. This mental shift is incredibly valuable and keeps you investing consistently instead of making emotional decisions. Let me talk about how to actually implement dollar cost averaging in your own investing. The first step is deciding how much you can invest on a regular basis. This should be money you won't need for at least 5 years, ideally much longer, and it should be an amount you can sustain every month without stress. Maybe it's $50, maybe it's $500, whatever fits your budget. The amount matters less than the consistency. Next, decide on your schedule. Most people choose monthly because it lines up with when they get paid, but you could do it weekly or every 2 weeks if you prefer. The key is picking a schedule and sticking to it. Then you need to choose what you're investing in. For most beginners, I strongly recommend low-cost index funds that track the broad market. Like a total stock market index fund or an S&P 500 index fund, these give you instant diversification across hundreds or thousands of companies. And they're perfect for dollar cost averaging because they represent the overall market rather than individual stocks that could go to zero. Once you've picked your fund, set up automatic investments. Almost every brokerage allows you to automatically transfer money from your bank account and purchase your chosen fund on a schedule. This is critical because it removes the temptation to skip months or to try to time your purchases. The money comes out automatically, the shares get bought automatically, and you don't have to make any decisions. This automation is what makes dollar cost averaging work for real people in the real world. Now let me address some common questions and concerns people have about dollar cost averaging. The first one is, what if I'm doing this and the market just keeps going up? Won't I miss out on gains? This is a valid concern. If the market goes straight up for the entire time you're dollar cost averaging, you would have been better off investing everything at the beginning. But here's the thing. You don't know if the market is going to go straight up. It might go up for a while and then crash. It might go sideways. It might drop first and then recover. By dollar cost averaging, you're protecting yourself against the worst case scenarios while still participating in the upside. You might not maximize your gains in the best case scenario, but you dramatically reduce the chance of making a catastrophic mistake. Another question is, how long should I dollar cost average before I'm fully invested? This depends on your situation. If you're investing regular income from your paycheck, you'll be dollar cost averaging forever, and that's great. You're continuously adding to your investments month after month, year after year. But if you have a one-time windfall, like an inheritance or a bonus, and you're trying to decide whether to invest it all at once or spread it out, a common approach is to spread it over 6 to 12 months. This gives you some of the benefits of dollar cost averaging while not taking too long to get the money invested and working for you. There's no perfect answer, but something in that range is reasonable. People also ask if dollar cost averaging works in a bear market when the market is going down for an extended period. The answer is yes, and actually it can work even better. When you're buying consistently while prices are dropping, you're accumulating shares at increasingly cheaper prices. Then when the market eventually recovers, which it historically always has over long periods, all those shares you bought at low prices surge in value. Some of the best wealth-building opportunities come from consistently investing during bear markets when everyone else is too scared to buy. Let me give you a real historical example to drive this home. During the 2008 financial crisis, the stock market lost about 50% of its value from peak to bottom. If someone had invested a lump sum right at the peak in late 2007, they would have been down 50% at the worst point in early 2009, and it would have taken several years to recover. That's a psychologically brutal experience. But if someone was dollar cost averaging throughout that entire period, investing the same amount every month from 2007 through 2009 and beyond, they were buying shares at progressively lower prices as the market fell, and then they captured the entire recovery. By 2013, they would have been significantly ahead, and by 2020, before the pandemic, they would have multiplied their money several times over. The person who was too scared to invest during the crisis, or who sold at the bottom, missed out on one of the best investment opportunities in history. This is the power of dollar cost averaging combined with a long-term perspective. You're not trying to predict crashes or time recoveries. You just keep showing up, investing your consistent amount, buying shares regardless of the price, and letting time and compound growth do the work. It's boring, it's simple, and it works. Let me also mention that dollar cost averaging pairs perfectly with the concept of paying yourself first. This is where you treat your investment like a bill that must be paid before anything else. When your paycheck comes in, before you spend money on discretionary stuff, before you even see the money in your checking account, it automatically goes to your investment account and buys your shares. This ensures that investing happens consistently and you're not tempted to skip months because you want to buy something else. One more important point. Dollar cost averaging doesn't mean you should never have any cash on hand. You should absolutely have an emergency fund of 3 to 6 months of expenses in a savings account before you start aggressively investing through dollar cost averaging. This emergency fund protects you from having to sell your investments at a bad time if something unexpected happens, like a job loss or medical emergency. Once your emergency fund is in place, then you can confidently commit to dollar cost averaging because you know you won't need to touch that money. Now, I want to be realistic about what dollar cost averaging can and can't do. It can't guarantee you'll make money. The market could go down and stay down for years, and you'd lose money, even with dollar cost averaging. But over long periods like 20 or 30 years, the market has historically trended upward, despite all the crashes and recessions. So dollar cost averaging into a diversified index fund has been a winning strategy for patient investors. Dollar cost averaging also can't make you rich quickly. This is a slow, steady, wealth-building strategy. You're not going to double your money in a year, but you might very well multiply it several times over a few decades. The real beauty of dollar cost averaging is that it's a strategy that works for anyone at any income level. You don't need to be wealthy to start. You can begin with whatever amount you can afford, even if it's just $25 or $50 a month. As your income grows over time, you can increase how much you invest, accelerating your wealth building. But the most important thing is just to start. Every month you delay is a month of potential compound growth you're missing out on. Before we wrap up, I need to remind you that everything I've shared in this video is for educational purposes only and not financial advice. I'm not a licensed financial advisor, and your personal situation is unique. You should do your own research and consider consulting with a professional before making investment decisions. My goal is to help you understand dollar cost averaging so you can make informed choices, not to tell you exactly what to do. So here's what you need to remember. Dollar cost averaging is investing a fixed amount on a regular schedule regardless of market conditions. It removes the need to time the market, reduces the emotional stress of investing, and automatically helps you buy more shares when prices are low and fewer when prices are high. It's perfect for people investing regular income from a paycheck, and it helps you actually start investing instead of sitting on the sidelines forever. To implement it, decide how much you can invest consistently. Pick a schedule like monthly, choose a low-cost index fund, and set up automatic investments so it happens without you thinking about it. Stay consistent through market ups and downs and give it time to work. Dollar cost averaging won't make you rich overnight, but combined with patience and a long-term perspective, it's a proven strategy that's helped millions of regular people build substantial wealth. It's not exciting, it's not sexy, but it works. And sometimes boring and reliable is exactly what you need. If this video finally helped you understand dollar cost averaging and gave you the confidence to actually start investing instead of waiting for the perfect moment, I'd really appreciate it if you hit the like button. And if you want to keep learning about simple, proven investing strategies that actually work for real people, subscribe to the channel. In the next video, I'm going to show you exactly which index funds are best for dollar cost averaging and how to set up your automatic investments step by step. Thanks so much for watching, and I'll see you in the next one.